Three of the most financially sophisticated governments in modern history crossed the point of no return without recognizing it. Not because their analysts were incompetent, not because the data was hidden, but because the system they were measuring was still producing the correct outputs, while the assumption underneath it had already quietly shifted. That is the part that never makes it into the headline. In 1881, the Ottoman Empire did not collapse, it was reorganized. A foreign creditor board was handed direct authority over 6 of its domestic tax streams, and the government in Istanbul kept issuing policy as though it still controlled the levers it had just signed away. In 2001, a Buenos Aires accountant checked her savings balance on a Tuesday morning, saw the same number she had seen on Monday, and by Thursday that number had been legally repriced to a fraction of its dollar value, with no warning in the financial press the week before. In 1923, a Berlin printer ran presses around the clock, producing currency that the population had already stopped trusting before the government had stopped printing it. And the institution of money continued to function officially while it had already socially ceased to exist. 3 governments, 3 centuries, 3 completely different political architectures, and in each case the sequence ran the same way. 5 stages. The same mechanism, the same interval between when the structure stopped working and when the structure admitted it. The United States is currently operating inside stage 4 of that sequence. Not approaching it, not at risk of entering it inside it. While the quarterly reports continue to issue and the institutional language continues to describe a system functioning within normal parameters. This is the creditor inversion, and what it reveals is not a conspiracy, not a political failure. Not an accident of bad leadership, but a structural pattern that has reconfigured productive nations into financing vehicles for the institutions they built to protect themselves. Every time the same 5 stages, every time with official reassurance at each transition. If understanding where a system is in its own sequence matters to you before the transition becomes the story, stay with this, because the mechanism becomes visible in the next layer, and once you can see it, the signals are not difficult to read. To understand the creditor inversion, you have to first set aside the version of this story. You have probably already heard the one about governments spending too much, printing too much, borrowing beyond their means, as though the mechanism is simply a budgeting problem that stricter discipline could correct. That version's not wrong exactly, but it is watching the symptom and calling it the disease. What the creditor inversion describes is something more structural and, in a way, more uncomfortable, because it does not require corruption, it does not require incompetence, and it does not require any single catastrophic decision. It requires only that a productive system build institutions larger than its surplus can sustain, and then do what every rational actor does. When that gap appears, it finances the difference. Think about what happens when a mid-sized American city builds a public hospital during a decade of strong property tax revenue. It staffs the hospital at full capacity, negotiates union contracts with built-in escalation clauses, and issues 30-year municipal bonds to fund the facility. Then, over the following 15 years, it watches the manufacturing base that generated that tax revenue gradually relocate. The hospital does not close. The contracts do not renegotiate automatically. The bond payments do not pause. The institution continues to operate, and the city begins covering the gap through a combination of state transfers, federal grants, and refinanced debt obligations. Every year that arrangement continues, the city is not in crisis. It is, by every official measure, functioning. That is stage 3 of the creditor inversion running inside a single municipality, and it does not feel like collapse. It feels like management. The mechanism the creditor inversion tracks is the progressive transfer of economic agency from the productive population to the creditor structure that finances the gap. The reason it is difficult to see from the inside is that each individual step in that transfer looks like a solution. A loan that buys time, a refinancing that lowers the monthly payment, a federal backstop that keeps the institution open. None of those individual decisions are wrong in isolation. But the cumulative direction of them is always the same. The entity that once produced is progressively redirected towards servicing the entity that lent. This is not a debt cycle in the simple sense of borrow and repay. In the creditor inversion, repayment is not the structural destination rollover is. The debt does not get retired. It gets extended, restructured, refinanced. And the cost of that continuous rollover is paid not from surplus, but from the productive capacity of the population the institution was originally built to serve. There is a particular kind of financial arrangement that captures this precisely: the interest-only mortgage, not as a metaphor, but as a structural analog. A household that takes an interest-only loan is not building equity with each payment. It is maintaining access to an asset it does not own in any accumulating sense. The payment is current, the balance is unchanged, and the arrangement continues as long as the lender agrees to keep extending it. The moment the lender's terms change, the household discovers that years of on-time payments have not moved the underlying position by a single dollar. The creditor inversion is what happens when that arrangement scales from a household to a national institutional structure. And the question it leaves open is not whether the payment is current, it is who decides when the terms change. That question is where the 5 stages become visible. Every stage in the creditor inversion follows the one before it with the logic of a slow gear system, each rotation driven by the previous one, the mechanism not dramatic but continuous, and the movement invisible if you are watching only the output rather than the ratio between what goes in and what comes back. Stage 1 is productive surplus. It is the only stage that feels unambiguously stable, because in stage 1, the institutions are downstream of the production. The economy generates real output trade surplus, manufactured goods, agricultural yield, technological innovation, and the institutions, the government, the military, the social infrastructure, are funded by that output as a secondary claim, not a primary one. Production comes first, and the institution takes a portion of what it generates. The American image for stage 1 is not abstract. It is a specific postal zip code in 1955, a factory town in Ohio or Pennsylvania or Michigan, where the plant payroll supports the school district, the hospital, the pension fund, and the municipal bond rating. The institution is genuinely downstream of the work. Cutting the institution would mean cutting something the productive base had already funded and would fund again next quarter. In stage 1, the relationship is directional: production generates, institutions receive. Psychologically, stage 1 produces a particular kind of confidence that is not arrogance exactly, but structural. People believe the system is self-sustaining because they can see the thing it runs on. The plant is there, the payroll is there, the pension contribution is being made. The institution feels permanent because the ground underneath it is visible and solid. Stage 2 is institutional expansion, and it is the stage most frequently misread as prosperity. In stage 2, the surplus is real and the expansion is funded. Institutions grow because the productive base is genuinely strong enough to support growth. New programs are created, military capacity extends, administrative structures deepen, and social commitments are made in legislation that locks them into the budget as automatic obligations. None of this is irrational in stage 2, because the numbers support it at the moment the commitment is made. The problem stage 2 creates is not financial, it is structural. The institutions that expand in surplus conditions carry fixed costs that do not contract with the productive base if that base weakens. The suburban school district that builds the administrative campus in a good revenue decade does not automatically reduce its administrative headcount when enrollment declines 15 years later. The staff contracts, the facility maintenance schedule, the technology systems, the insurance obligations, they all continue on stage 2. Assumptions inside a stage 3, fiscal reality. Stage 3 is creditor dependence. This is the stage where the language of the system begins to diverge most significantly from the mechanism underneath it. The gap between what the institutions cost and what the productive base generates is filled by external financing, and that financing is described not as a structural gap, but as a policy tool. The government is not failing to cover its obligations from its own output. It is strategically leveraging debt markets to invest in future capacity. That framing is not dishonest exactly. It is the rational interpretation of a stage 3 decision from inside a stage 3 institution. Think of a regional airline that issues bonds to finance a fleet expansion during a period of strong travel demand. The bonds are not irrational, the demand is real, the fleet generates revenue. But if travel demand softens before the fleet is paid down, the airline cannot simply stop the bond service. The obligation continues regardless of the revenue environment. If the softening is structural rather than cyclical, the airline will refinance the bonds rather than retire them and refinance again. The fleet that was supposed to generate the surplus to repay the debt becomes the operational requirement that makes the debt necessary to maintain. Psychologically, stage 3 is the most stable feeling of the unstable stages. The institutions are open, the payments are current, the credit rating is maintained, and the official language describes the arrangement as manageable. That is not propaganda, it is the sincere belief of people operating rationally inside a system they have not yet seen from the outside. Stage 4 is extraction inversion. It is the stage the United States is currently operating inside. It is called inversion because the direction of the claim has reversed. In stage 1, the productive base funded the institutions as a downstream recipient. In stage 4, the productive base is being extracted to fund the creditor structure that finances the institutions. The arrow has turned. What was built to serve the population is now being serviced by the population, and the population experiences this not as a dramatic announcement, but as a compression. Things cost more, wages cover less, the return on participation in traditional financial structures declines, and savings grow more slowly than the cost of the things savings are supposed to purchase. The American image for stage 4 is a household in which both adults are working. The income is stable by historical standards. The mortgage is current, the car payments are current, the health insurance premium is being paid. And yet the household cannot accumulate a meaningful reserve because the gap between income and the cost of maintaining current obligations leaves nothing for actual accumulation. The household is not failing, it is servicing. It is covering the cost of access to a system that was supposed to generate upward mobility, but is currently absorbing all of the margin that mobility would require, that participation contracting from beneath it. At stage 5, the assumption has already changed before the structure has registered it, and that interval between behavioral shift and institutional acknowledgement is where the velocity of transition lives. What determines how fast stage 5 moves is not the size of the economy or the sophistication of its institutions. It is how synchronized the behavioral shift is across the actors whose participation the system requires. And that is where the 3 case studies become more than history. In 1854, the Ottoman Empire took its first major foreign loan. By every measure available at the time, it was the rational decision. The Crimean War required financing that the existing tax base could not provide quickly enough. British and French banks offered terms that were manageable against the expected revenue trajectory. The loan was serviced, the war was concluded, and the empire continued to function as the dominant power across its territory. What 1854 initiated was not a debt problem in isolation. It was the structural precedent that external financing was an available tool for covering the gap between institutional cost and domestic revenue. And once that precedent exists, the mechanism does not require a new crisis to activate it again. It only requires the next gap. Between 1854 and 1875, the Ottoman government took 14 separate foreign loans, not from recklessness, but from the structural logic of stage 3. Each loan addressed a specific obligation, a military commitment, an infrastructure investment, an administrative expansion, and each one was rationalized within the framework of a government managing its obligations strategically, which is precisely what it was doing, and precisely what stage 3 always looks like from the inside. By 1875, the arithmetic had inverted. More than half of the Ottoman budget expenditure was being directed toward debt service, meaning the government's primary financial activity had become paying for the cost of the financing it had used to cover a gap that the financing had never actually closed. In that year, the government declared partial default, not collapse, not dissolution, a restructuring, a renegotiation, the formal acknowledgement that the stage 3 arrangement could not continue on its existing terms. The response to that restructuring is what makes the Ottoman case structurally significant. In 1881, the creditors did not simply extend new terms, they formalized institutional capture. The Ottoman Public Debt Administration was established as a board controlled by European creditor representatives, given direct administrative authority over 6 Ottoman domestic revenue streams, including the tobacco monopoly, the silk duties, and several regional tax collections. The Ottoman government did not cease to exist. Elections continued, ministers were appointed, policy was announced. But the revenue streams that had previously flowed into the government's discretionary capacity now flowed first through a creditor-controlled administrative structure, which extracted debt service before the government received anything remaining for its own operational priorities. Consider what that looks like from inside the system. A government official in Istanbul in 1882 overseeing a regional tax collection in which the collectors are reporting not to the finance ministry but to a foreign creditor board operating from a separate administrative location. The tax is being collected from Ottoman citizens on Ottoman territory under Ottoman legal authority, and the proceeds are being routed to service obligations that the Ottoman government incurred to maintain Ottoman institutions. The official is managing a process he no longer controls, toward an output that serves a structure above the government he represents. The structure was still reporting, the tax was being collected, the institution was functioning, and the assumption that the government controlled its own fiscal capacity had already quietly become incorrect. The Ottoman Empire did not collapse in 1881, it continued for another 4 decades, and that is part of what makes it instructive rather than simply cautionary. Stage 4 can be sustained for a significant period. During that period, the official indicators continue to describe a functioning system. Because the system is functioning, it is simply functioning in a different direction than its original design specified. The question the Ottoman case leaves open is not historical, it is structural. When the entity collecting the revenue reports to a different principle than the population that generated it, what is the institution actually administering? That question runs through all 3 cases. But the second one answers it differently. Because in Argentina, the capture was not administrative, it was monetary, and it moved not over decades, but over days. Argentina in 1991 was not a peripheral economy, attempting an amateur stabilization. It was a country with a highly educated professional class, significant agricultural export capacity, a functioning legal system, and a decade of hyperinflationary trauma that had made the population genuinely willing to accept structural constraints in exchange for monetary stability. The convertibility plan that year pegged the peso 1-to-1 to the US dollar, backed by a legal requirement that every peso in circulation be matched by $1 in reserves. For the first several years, it worked in the most visible and measurable sense. Inflation collapsed, growth returned, foreign investment entered, the middle class expanded its participation in formal financial systems, and savings accounts denominated in dollars accumulated. The official narrative of successful reform was not false, the indicators supported it. What the indicators did not surface was the structural gap the peg was creating underneath the visible stability. Maintaining the peg required that Argentina's productive base generate dollar-denominated export revenue fast enough to match the peso obligations the growing economy was creating. When that generation rate softened through a combination of commodity price shifts, Brazilian currency devaluation, and global capital market tightening in the late 1990s, the gap between what the peg required and what the productive base was generating had to be filled from somewhere. The IMF became that somewhere. The financing was not informal or improvised. It arrived through structured conditionality agreements that required specific fiscal adjustments in exchange for continued lending. Each agreement was presented as a reform program, a set of measures that would close the structural gap and restore the productive base to a trajectory that could sustain the peg without continued external support. The problem was that the adjustments required to satisfy the conditionality terms were politically and socially incompatible with the institutional commitments the government had made in Stage 2. The wage agreements, the provincial transfer obligations, the pension structures, they could not be reduced to the degree the financing terms required without triggering a social fracture that would itself destabilize the fiscal position the adjustments were supposed to improve. So each agreement was partially implemented. Each tranche was partially released, the gap was partially closed before reopening, and the cycle continued until it couldn't. By 2001, Argentina had received what was, at that point, the largest IMF support package in history, $40 billion. It did not prevent the collapse. Not because the number was insufficient, but because the structural problem the number was being asked to solve was not a liquidity gap, it was an assumption gap. The assumption that the peso and the dollar were the same thing had been sustainable when capital was flowing in. It became impossible to sustain when capital began flowing out. And no financing package can substitute for the shared behavioral belief that a currency represents what it claims to represent. In December 2001, the government froze bank accounts. And here is the specific texture of what Stage 5 feels like at the household level. A Buenos Aires couple who had spent the 1990s building dollar-denominated savings in a formal banking institution, following every conventional instruction about financial security, maintaining their account, paying their taxes, participating in the system the way the system asked them to participate, checked their balance in November and saw the correct number, checked it again in December and saw the same correct number, then received notice that the account was frozen and that when it reopened, the dollars would be legally converted to pesos at a rate that repriced their savings to approximately 30 cents on the dollar. The number had been correct. Until it wasn't. And the transition between those two states was not gradual, it was a legal announcement. It arrived without meaningful warning in the financial press in the week before it happened, because the press was also operating on Stage 3 assumptions inside a Stage 5 event. Within 11 days of the freeze, Argentina had 5 different presidents, not from revolution, but from the sequential political impossibility of governing a system whose monetary assumption had publicly collapsed. 5 presidents in 11 days. That is what Stage 5 looks like when the trust fracture is synchronized across the population rather than distributed across time. The third case moves the mechanism into a different register entirely. Because in Weimar Germany, the trust fracture did not run through a bank account, it ran through the unit of account itself. And once the unit of account is the thing that loses the population's trust, the institutional responses available become structurally fewer than any of the responding institutions were designed to recognize. The Weimar hyperinflation of 1923 is one of the most documented economic events in modern history, and also one of the most consistently misread. The conventional telling focuses on the printing of money as the cause and the destruction of savings as the effect. While both of those are accurate, the mechanism underneath them is the one the creditor inversion is tracking. Not the inflation itself, but the structural sequence that made the printing the only available institutional response. Pre-war Germany was Stage 1 in its clearest industrial expression, the most productive manufacturing economy in continental Europe. A sophisticated banking system, a technically educated workforce, a trade surplus that funded institutional capacity across education, infrastructure, and a military establishment genuinely underwritten by productive output rather than external financing. World War I moved Germany through stages 2 and 3 in 4 years. The institutional expansion of wartime military capacity was financed not through taxation, which the political structure could not sustain at the required scale, but through domestic bond issuance sold to the German population. As patriotic investment, the population bought the bonds believing the surplus of a victorious post-war economy would service them. That belief was not irrational in 1915. It was the reasonable projection of a Stage 1 economy that had never experienced a Stage 3 structural constraint before. Versailles created the creditor inversion's most explicit external imposition. The reparations obligation was a debt denominated in currencies Germany could not earn fast enough from its own productive output. The structural gap was not a policy choice, it was a treaty requirement. And the Reichsbank's response, printing marks to convert to foreign currency to meet reparations payments, was the institutional logic of Stage 3 applied to a Stage 4 constraint. What the Weimar case demonstrates that the other two do not is the specific moment when the population socially withdraws trust from the unit of account before the institution issuing that unit has acknowledged the withdrawal. By mid-1923, the German population was not waiting for the Reichsbank to announce that the mark was failing. They were behaving as though it had already failed. Workers demanded payment twice daily, because the purchasing power of a morning wage was meaningfully different from the purchasing power of an afternoon wage. Shopkeepers priced goods in foreign currency or in physical commodities, and accepted marks only as a conversion medium at the current exchange. The institution of currency continued to formally operate while it had already been socially abandoned as a store of value. Think about what that social abandonment looks like in a practical American texture. Imagine a situation in which a contractor completing a home renovation in a major American city begins requesting payment in a form other than the dollar because the interval between invoice and settlement involves enough monetary uncertainty that the dollar amount agreed upon at the start of the project no longer reliably represents the purchasing power that will exist at its conclusion. That is not a political event. It is a behavioral adjustment made by a rational actor who has updated their assumption about what the unit of account can be trusted to represent across a short time interval. And if enough contractors, across enough markets, make that same adjustment simultaneously, the unit of account has been socially withdrawn from one category of transaction, even while it continues to function normally in others. In 1923 Weimar, that withdrawal was total and rapid. The structural consequence was not simply economic disruption, it was the dissolution of the pricing mechanism through which the entire economy coordinated. Once the unit of account cannot be trusted to represent a consistent value, the rational calculation required to make any economic decision involving a time interval becomes structurally impossible. Not difficult, impossible. And the economy does not decline in that environment. It stops. Then reorganizes around whatever substitute unit of account is available, which, in Weimar, was initially the US dollar and eventually the Rentenmark. A new currency backed not by gold but by the shared decision of enough institutional actors to treat it as if it were backed by something real. That last detail is worth sitting with. The Rentenmark stabilized the German economy not because it was technically superior to the mark, but because the population and the institutions chose simultaneously to extend it the assumption they had withdrawn from its predecessor. The lesson that carries forward into the present is this: monetary stability is not a technical property of a currency. It is an ongoing social agreement about what a number means. And social agreements do not require permission to dissolve. 3 cases, 3 different centuries, 3 different political architectures, 3 different triggering mechanisms. And the sequence underneath each one is identical. The productive surplus funds institutional expansion. The expansion exceeds the surplus. Creditor financing fills the gap. The creditor claim inverts the direction of extraction. And trust fracture follows at a speed determined by the visibility of the assumption that breaks. Before mapping the current American indicators, it is worth pausing to confirm exactly where in the sequence we are, because the 3 cases each carried their own specific texture, their own political drama, their own historical detail, and it is easy to engage with the detail and lose the structural thread that connects them. The creditor inversion runs through 5 stages: productive surplus, institutional expansion, creditor dependence, extraction inversion, and trust fracture. What the 3 cases confirm is that the transition through those stages does not require any single catastrophic decision. It requires only the accumulated logic of rational actors responding to the constraints in front of them with the tools available, and each rational response moving the structural position one stage further along the sequence. The Ottoman government borrowed rationally in 1854 and was administering foreign creditor tax collections by 1882, not from incompetence, but from the structural logic of Stage 3 repeated 14 times, until Stage 4 formalized itself through institutional arrangement. Argentina stabilized rationally in 1991 and was repricing its citizen savings by 2001, not from corruption, but from the structural impossibility of sustaining a Stage 2 institutional commitment on a Stage 4 productive base, through Stage 3 creditor financing indefinitely. Weimar borrowed rationally during wartime and was watching its population socially withdraw from the unit of account by 1923, not from political failure, but from the structural gap between what the reparations obligation required and what the productive base could generate in the currency that obligation demanded. The United States is currently in Stage 4, extraction inversion, the stage in which the productive base is increasingly directed towards servicing the creditor structure that finances the institutional gap, rather than building the surplus capacity that the institutions were originally designed to support and amplify. Stage 5 indicators are present but not yet systemic. And the interval between those two descriptions is where the structural attention is most productive, because Stage 5, when it moves faster than the policy response cycle can track. That is where the American stage map begins. Stage 1 and Stage 2 are history in the American context, not distant or irrelevant history, but structural history. The decisions made during those stages created the institutional architecture that generates the current obligations. And understanding when Stage 2 locked in its commitments is more useful than debating whether those commitments were wise. The American Stage 2 commitment lock happened not in 2008 and not in 2020, but across the period from 1965 through 1983. The major entitlement structures were expanded and indexed. The defense posture was institutionalized at a level that successive political configurations found politically impossible to structurally reduce. And the federal budget's mandatory spending share began its long structural expansion from a minority of federal expenditure to the majority position it now occupies. Those commitments do not reprice automatically with the productive base. They escalate with demographic structure and healthcare cost inflation, which means the Stage 2 expansion is itself generating an expanding Stage 3 financing requirement, regardless of any new discretionary decision made by any current administration. The mechanism is running on the earlier commitment, not on present policy. The Stage 3 indicator to watch is not the total debt number, which is a cumulative stock figure that obscures the flow dynamics. The indicator to watch is the maturity profile of that debt specifically, the average duration of outstanding Treasury obligations, and the volume coming due for refinancing in any given 2-year window. The refinancing requirement is the mechanism through which the creditor's pricing power over the system becomes visible. When debt duration shortens, as it has over recent years, the Treasury must return to the market more frequently to roll existing obligations. Each return to market is an auction at whatever rate the current buyer pool requires, not the rate at which the original obligation was issued. A structural shortening of duration is a structural increase in the system's exposure to whatever assumption the buyer pool is currently making about the value of holding dollar-denominated government obligations. This is the structural analog to the Argentine peso peg, not identical in mechanism, but parallel in vulnerability. The system's stability depends on the continued willingness of a specific set of institutional actors to participate at terms consistent with the system's fiscal arithmetic. The moment those actors reprice their participation, the gap between what the system requires and what it can generate domestically becomes visible in the auction clearing rate rather than in any policy announcement. The Stage 4 indicator most directly felt at the household level is not the federal deficit figure, which is abstract at the lived scale. It is the interest-to-income compression that operates simultaneously at the government level and at the household level. The share of federal tax revenue consumed by interest payments before any discretionary allocation is made has been expanding structurally. At the household level, the share of median household income consumed by non-discretionary obligations, housing, healthcare, debt service, insurance, has been expanding in parallel. The experiential result of both compressions running simultaneously is the specific texture of Stage 4, not crisis, not collapse. Compression. The feeling that the system is still operating, but the margin it used to generate has gone somewhere you cannot quite identify and cannot get back. Think about a specific American household in 2024. 2 incomes, both employed in professional or skilled trade positions, income nominally higher than it was 5 years ago. And yet the household's net discretionary capacity, the income remaining after covering all fixed and semi-fixed obligations, is narrower than it was in 2019, despite the nominal income increase. The gap is not explained by profligacy. It is explained by the structural repricing of every obligation in the household's budget at a rate that has outpaced the income growth. The healthcare premium increased, the insurance renewal came in higher. The mortgage rate on the refinance was not the same as the original rate. The grocery basket cost more for the same contents. And the pension contribution is generating a lower real return than the assumption it was designed around. That household is not in crisis, and it knows it is not in crisis. It continues to operate, continues to participate in the formal systems of employment and finance and institutional life, and it feels the compression as a personal circumstance rather than a structural condition, because Stage 4 does not announce itself as a stage, it presents as individual experience. The Stage 5 early indicators are behavioral rather than numerical. Institutional trust data across multiple decades shows a consistent directional decline in expressed confidence in federal government, in the Federal Reserve, in the banking system, and in the financial institutions designed to translate individual savings into productive investment. The more significant signal is not the expressed opinion data, it is the behavioral divergence, the degree to which younger cohorts are allocating savings toward instruments that sit outside traditional institutional channels. Not ideologically, but structurally, because the return on participation in the traditional institutional framework has not delivered the assumed value that was supposed to justify the participation cost. The pension solvency gap is the Stage 5 indicator that carries the most structural weight and receives the least consistent public attention. The unfunded liability of state and municipal pension funds across the United States operates on return assumptions in the range of 7% annually. Those assumptions have not been consistently met across the period since 2000, which means the pension structures are carrying a forward obligation that their current asset base cannot service at the assumed rate. The gap between what is promised and what the asset base can deliver is not small enough to be closed through incremental adjustment. It requires either a repricing of the obligation, a structural change in the investment return environment, or a political decision about which obligations survive when the gap becomes publicly impossible to obscure. The 401k statement is the American household's interface with this structural gap. The number on the statement is real. It accurately reflects the current market valuation of the assets held. But the value of that number is conditional on an assumption that has never been stress tested at the scale of a simultaneous drawdown by a demographically large cohort requiring the assets to convert to income at the same time in the same market conditions. The stage map for America is not a prediction. It is a structural description of where each mechanism of the creditor inversion is currently operating. And Stage 4 is not a warning about what might happen. It is a description of what is happening in the government's interest-to-revenue ratio, in the household's discretionary compression, in the maturity profile of the national debt, and in the behavioral early signals of Stage 5 beginning to form at the edge of the institutional trust structure. What moves the system from where it is to where Stage 5 operates fully is not a policy failure or a political event. It is a threshold, and the next section is where that threshold becomes specific. In all three historical cases, the transition from Stage 4 to Stage 5 was not initiated by a collapse event. It was initiated by a repricing event, a moment in which a key institutional actor adjusted the terms on which it was willing to continue participating in the Stage 3 financing arrangement. And that adjustment changed the structural arithmetic of the system faster than any response mechanism within the system was designed to process. The Ottoman creditors did not declare the empire insolvent in 1881. They formalized a new institutional arrangement in which their claim on Ottoman revenue streams was prioritized above the government's discretionary allocation. That formalization was not a rupture, it was a term change. The financing continued, the arrangement changed, and the change transferred the structural agency that Stage 4 had been compressing. The IMF did not refuse Argentina's final request in 2001. It conditioned approval on adjustments that the Argentine government had already demonstrated it could not politically deliver. That conditionality was not punitive, it was structural. The financing mechanism could not be extended on the previous terms because the previous terms had not moved the structural gap in the required direction. The conditionality acknowledged that without declaring it, and the acknowledgement was the trigger. The Weimar Central Bank did not decide to abandon the mark. The German population decided to withdraw behavioral trust from it. That withdrawal was the trigger not because it was organized or intentional, but because it was simultaneous enough across enough actors to change the behavioral mathematics of the monetary system faster than the institutional response could address. 3 different trigger mechanisms. But each one is a threshold rather than an event, the moment when the gap between the assumption the system is running on and the reality the system is operating in becomes large enough that a key actor adjusts their behavior to the reality, rather than continuing to operate on the assumption. For the United States, there are three structural threshold mechanisms worth tracking not as predictions, but as the specific behavioral signals that would indicate the Stage 4 to Stage 5 transition is accelerating. The first is the Treasury auction signal, not a failed auction, which is a dramatic and unlikely event, but a clearing rate signal. A sequence of auctions that clear at meaningfully higher yields than the forward projections of the fiscal arithmetic assumed. Each basis point of yield increase on the refinancing of existing debt is a direct addition to the interest-to-revenue ratio that is already compressing the government's discretionary capacity. And the feedback between higher clearing rates and expanding mandatory interest expense is nonlinear once it reaches a certain level of the budget. The second is the policy coherence signal, the moment at which the Federal Reserve faces a condition requiring contradictory tool applications simultaneously. Persistent inflation that requires contractionary policy, combined with a growth contraction and a credit stress event that requires accommodative policy, and must choose between them in a way that is publicly incoherent. The institutional legitimacy of the central bank rests on the assumption that it has a coherent policy response available to the conditions it faces. A publicly incoherent response is itself a trust fracture event at the institutional level. The third is the disclosure signal, a pension system, state government, or major institutional fund that publicly discloses an insolvency gap that cannot be addressed within the existing policy framework. Not a bankruptcy filing, which is a legal event with established processes, but a disclosure. Because disclosure is the moment the 401k analogy becomes a specific account statement that a specific household reads on a specific morning, and begins to make behavioral adjustments that were not part of the plan. None of these three mechanisms require a dramatic exogenous shock. They are all internal to the system's own operation, and they all run through the behavioral decisions of institutional actors making rational adjustments to information they are receiving about the gap between the assumption and the reality. That is why they are difficult to observe from inside the system and structurally legible from outside of it. The system does not warn you when the assumption is about to change. It continues to report normally until the behavioral adjustment has already begun. And the interval between that adjustment beginning and its consequences becoming visible in the official indicators, that is the window the structural model is most useful for navigating. The creditor inversion is not a prescription, it is a map. And a map does not tell you where to go. It tells you where you are and what the terrain looks like in the direction you are facing. That distinction is worth maintaining carefully, because the structural clarity the model provides is most useful as a positioning tool rather than a forecasting one. There are three ways people characteristically sit inside a Stage 4 system that is showing early Stage 5 signals. And none of them are irrational. They are each rational responses to the information available and the risk tolerance of the person holding it. The first response is to continue operating on Stage 3 assumptions, to treat the compression as cyclical rather than structural, to maintain participation in the institutional frameworks on the assumption that the system has navigated similar pressures before and will navigate them again, to keep the 401k allocated the way the institution recommends, to maintain trust in the purchasing power trajectory of the savings account, and to interpret Stage 4 compression as temporary friction in a fundamentally sound system. This is not a naive response. It is the response of someone who has correctly observed that systems operating in Stage 4 can sustain that stage for significant periods. The Ottoman Empire continued for 40 years after the Public Debt Administration was established. Argentina sustained the convertibility arrangement for a decade after the structural gap appeared. Operating on Stage 3, assumptions inside Stage 4 is often materially correct for longer than the structural pressure would suggest. The risk of this position is not that it is wrong about the system being functional. It is that Stage 5, when the transition arrives, moves faster than the response time available to someone operating without structural awareness. The Buenos Aires accountant, who was unaware of the gap between the peso peg's assumptions and its underlying mechanics, had no behavioral adjustment time when the freeze arrived. The adjustment was made for her by the institutional announcement. The second response is to treat Stage 4 indicators as confirmation that Stage 5 is imminent, and to position accordingly on an urgency timeline that the structural model cannot actually support. The model shows the sequence, but not the calendar. Positioning on an urgency assumption that turns out to be premature carries its own cost, both financial and cognitive. The person who has been in maximum defensive posture for 5 years against a Stage 5 transition that has not yet arrived has paid the cost of that posture without receiving the protective benefit. The third response is to shift from outcome prediction to assumption monitoring to identify the specific behavioral signals that would indicate the Stage 4 to Stage 5 transition is accelerating. To watch the Treasury auction structure, the Federal Reserve's policy coherence, the pension disclosure environment, and the household behavioral data around institutional participation, not as a countdown, but as a structural dashboard. To make decisions based on what those signals are actually showing, rather than on either the assumption that the system is fundamentally sound or the assumption that collapse is structurally imminent. This is the cognitive position the structural model most naturally supports, not because it is the most comfortable or the most actionable, but because it is the most accurate to what the model can actually tell you, where you are in a documented sequence, and what the behavioral signals of the next transition look like, without claiming to know when the threshold will be crossed. The Ottoman merchant who understood that the Public Debt Administration controlled the tax collection process had information that the Istanbul financial press had not yet described as structurally significant, and the behavioral adjustments available to someone holding that structural awareness were different from those available to someone waiting for the official announcement. The creditor inversion has run through monarchies and democracies, through industrial economies and agrarian ones, through empires with global military reach and republics with sophisticated institutional frameworks. And in every case, the mechanism was the same: the productive surplus funded institutional expansion. The expansion exceeded the surplus. Creditor financing filled the gap. The creditor claim inverted the direction of extraction. And trust fracture followed at a speed determined by the visibility of the assumption that broke. The United States is currently operating in Stage 4, and Stage 5 indicators are present at the edges of the institutional trust structure in the pension solvency gap, in the household discretionary compression, in the behavioral data around younger cohorts, and in the maturity profile of the debt that the creditor structure is being asked to continue rolling forward at whatever terms the next auction requires. The system does not care whether you believe in it. That is not a provocation. It is the structural point the 3 cases confirm. The Ottoman official who doubted the Public Debt Administration's authority still administered its collections. The Argentine household that trusted the peso peg still received the repricing notice. The Weimar printer who continued to believe in the mark's institutional legitimacy still ran the presses that completed its social abandonment. The structure holds until the assumption underneath it changes and the assumption does not announce its own instability. It continues generating the outputs the system is designed to report, until the gap between the report and the reality can no longer be described as a rounding error. Think of a household refinancing notice that arrives in an ordinary envelope on an ordinary Tuesday. Nothing in the exterior signaling that the terms inside are different from the terms expected. The system still reporting. The assumption already repriced. On this channel, we continue tracing the mechanism as it evolves because the next signal worth examining is not behind us in the historical record. It is forming now in the behavioral data of the institutions whose participation the current assumption requires. The sequence is documented, the position is readable, and what comes next is not a prediction, it is a question worth staying close to.